All right, we've got a few more people coming in here. We'll let them get settled in. So we're gonna have Q&A after we get done with just going over this brief PowerPoint, so y'all can ask whatever questions you might have. And let a few more click in here. All right. All right, cool. So my name is Josh Appelman. I'm with Equity Group. It's our sponsor, as well as Appelman Properties. And today's we are going over apartment syndication basics. So it's just going over the fundamentals, the mechanics, and apartment syndication versus, say, a joint venture agreement. Again, my name is Josh Appelman, and learning a little bit more about myself. Who is Josh? Me. And introduce you to my family. I've got Mariana as my wife, my two kids, Dean and Annabelle. Dean just turned 9, Annabelle is 6. So I'm a master and student of success. I've built from scratch 3 companies reaching 7 figures, one of which went to 8 figures with 5 consecutive years on the Inc. 500, 5,000 list. That was certainly exciting times. I'm passionate about building partnerships and creating long-term value. So creating value with partnerships, that's what it's about. Everyone wins, and it's fun along the way. Companies that I personally own. So currently Appelman Properties, that's my holding company. So when we take down a large asset, I'll have Appelman Properties in front of me as the investor. So that basically shields me or another layer of protection from any liabilities. And then we've got Equity Group. So Equity Group is the party that goes and seeks properties to invest into. We'll do the underwriting, we'll do the sourcing, we'll work with the debt brokers, we'll sign on the loans. So Equity Group is a front-running company. It's kind of a blanket, and then it's a part of the syndication. All right, examples of some properties that we own. So up here in the right is our corporate office. We built this back in 2017. Down here in the middle is Willow Run. That was our first apartment complex we've purchased. We still own that today. Left is a value add property that we've done. That's Avery Apartments. So we rebranded the property. We renovated it. We essentially it was the worst property on the block. It's a heavy value add. And we, of course, repainted the exterior, put all new tenants in place, all new renovations. It's a very fun project. And it had some great returns, still does. Okay, so why real estate? A little bit about real estate. It's been around for thousands of years, even from the medieval times in Europe and to ancient Chinese and Indian civilization. Even today. So you'll see us go into war over territory. It's all about controlling territory and assets. And real estate is a hard asset. Controlling and owning land is one of the most basic proven ways for wealth. That's why starting with even owning your own property can lead to much bigger things. It's just a compounding effect with real estate. Real estate's versatile, extremely versatile, can harness the power of a side hustle if you start out in that way, and it can lead to a full-time career. Personally, I've experience on both sides from it being something that I've wanted to just dabble in to now we're full-time real estate investors. Okay, so why real estate? 8 advantages. You've got appreciation, depreciation, cash flow, rapid depreciation, which is accelerated. Once initiated, can be automated. Government encourages real estate incentives with taxes and debt. You've got the power of leverage, and then scale and diversification. So real estate education, if you're along your path to get educated, to start your career, Robert Kiyosaki, one of his quotes that I like is, it's not the investments that is risky, it's the investor. So that's where educating yourself can make the investment successful. And then learn about real estate through the 4 different mediums. You've got your podcast, your books, community RIAs, bigger pockets, thought leadership, experienced investors. So here we're on a meetup group. So you've got your communities, you've got places that you can join and get educated. Here are some books that I would suggest you taking time to read. It can change your mindset. It can give you little insights to things that can make you successful in real estate. If you want to take a moment, screenshot this, take a picture. But don't just read the books once, read them multiple times. I personally use Amazon audiobooks. So while I'm driving, while getting ready in the morning, really when I have any free time, I'm constantly educating myself with just different books. There's people that have already been here and done this. They've created the path forward. So there's no reason to fail when you've already got a proven path to success, and just harnessing the power through books. All right, apartment syndication basics. This is what we're here today for. And disclaimer, this webinar is for informational purposes only. I'm not a financial advisor, accountant, or etc. So of course, just always engage with professionals to get your advice. Don't count on me or this video. What is apartment syndication? All right, it allows you to share risks and returns, tax advantages. The day we assign the documents to close, we're already making money. So apartment syndication is essentially pulling a group of investors together, and we're all going to take down a large asset. We're all going to pull our money together to put down for the earnest money, for the down payment, for the debt, for the legal, to structure the entire thing. We're all coming together as a group. We're going to syndicate a large investment. So if it's, say, $10 million property, and we need to put up $2 million to purchase it, we're going to get X amount of individuals to come in and purchase the property together. So we'd have a general partnership, which would be the operators, the people that are running the deal, making sure it's a success. And then you've got your limited partners. So you've got GP and LP, and they're separate entities. Limited partners, they don't share a role in the management of the property or necessarily decisions. We're going to leave that to the operators, to the general partnership. But limited partners want to partake in the deal and benefit from the upside. So you've got limited partners and you've got general partners take down large deals. Apartment syndication is probably best when it's $1.5 million more. That way your returns aren't diluted to the point where it doesn't make sense. So you want it to be significant enough to make sense. Like a joint venture, you'd have maybe one or two other partners in a smaller deal to where you all benefit from the project and the returns. They're large enough to make everyone happy because everything takes time, and it's about where you spend your time at. So if the project takes 24 months to make money off of, and it's only going to return, say, maybe a few $1,000s, it's not really worth the time, versus maybe something that could return a few $100,000 on a larger deal with less people. Less people would be a joint venture. Okay. What is apartment syndication? Again, it's maybe we got this mislabeled, but the depreciation. Another thing we take advantage of in real estate is depreciation. To me, it's the magic money. It's essentially it's free money, and it's given to us from the U.S. government, and it's depreciating the fixtures and the structure of the building over the course of time. So since multifamily is considered a residential, it's 27 years, 27 and a half years of depreciation over the course of time. Things deteriorate, and you're able to capitalize on that depreciation, because essentially it's money that you're spending, or that the property is deteriorating, so it's money that's going away, and you're able to write that off on your taxes. Commercial is 39 years, so there's a difference there, but residential is 27. Standard depreciation is just taking that over the course of 27 years. You can't depreciate the land, but you can depreciate the structure. So it'd be depreciating the wiring, the wood, the windows, the carpet, the flooring, the cabinetry, the plumbing fixtures. What we would do in a syndication is we would get a cost segregation study done. And the IRS actually wants you to get a cost segregation study done because it categorizes everything into a nice report, and it shows you a schedule of depreciation that you're able to take on a yearly basis. And you can do a accelerated depreciation as well, which take it all within the next 5 or 15 years, and you're able to take that money now versus later, which is all in tax code. And then in Trump's presidency, he introduced bonus depreciation, which is where you're able to take up to 100% of the depreciation in year one. So say you've got say you're going to be showing a profit of $400,000 on your taxes, you could essentially take that depreciation and wipe out the profit on your taxes, and essentially it's free money. Of course, talk to a tax professional about this strategy, but this is a part of apartment syndication. This is why we like it. You're able to capitalize in many different ways to types of depreciation. All right, passive investors versus active investors. All right, so an individual who is considered a qualified investor can be categorized as either a accredited investor or a non-accredited investor or a sophisticated investor. So when we've got an offering, we're going to have to consider who we want investing in this project, and they've got to be qualified through the SEC or through the SEC guidelines. An accredited investor is someone who's got a net worth of over $1 million. And or makes over $200,000 a year or $300,000 a year with themselves and their spouse. So an accredited status as an investor, that's the SEC's guidelines of who an accredited investor is. That might not necessarily mean that they would be a sophisticated investor. A sophisticated investor is someone who might not have the $1 million net worth, might not be making $200,000 a year, but they've got the knowledge to know how to determine a good investment from a bad investment. They know how to underwrite, they know how to do all the due diligence, they know what makes up a good investment. So a sophisticated investor could qualify as a qualified investor in a project. A non-accredited investor might be a family member or a friend, which you can bring in on a SEC Reg B. They're not accredited, but they've got, say, $50,000 to invest. So you know them, you're close to them, you've got a relationship with them, and you can bring them in on a deal just by knowing them. They're not accredited and they're not sophisticated, but there's a relationship there. Syndicators may restrict some investment opportunities to accredited investors because of being qualified, because a qualified investor depends on a specific deal. So depending on what regulation you take with the SEC, whether it's regulation A, regulation B, or a regulation C, or CF, crowdfunding, will limit who you can bring in on a deal. So regulation C, you can advertise the deal to the general public, but you might not necessarily be able to bring in your family members or your friends. So you need to determine which direction you want to go on the onset of offering the deal, and make sure that it's going to fit the purpose of the project and the project goals. So again, this is the difference between qualified investor and sophisticated and accredited. Accredited versus non-accredited versus syndicated or sophisticated, sorry. To be considered an accredited investor, an individual must have either a net worth of at least $1 million or an annual income of $200,000 if they're single. If they're married, it's $300,000. And this will this is again SEC guidelines. It's what they've set as a standard, as a rule, and SEC is there to protect essentially everyone that has deals offered to them, to make sure that that things are being done to the really the best interest of the investor. When you fail to meet the qualifications of an accredited investor, you are considered non-accredited. So again, just because you're non-accredited doesn't mean that you're not able to invest. It means that it means that you're not able to invest into specific deals. It means that that maybe your friend or family member who is a syndicator, it means that you can still possibly go in on his deals if it feels that you're fit. But it does not qualify you to go out there into deals that may be more risky, to where they want accredited investors in on the deal. Sophisticated investors possess the knowledge and experience required to evaluate the risks and merits of the investment, particularly in finance and business. So sophisticated investors, they might not be accredited, but they know exactly what the investment takes to be successful, and they know the risk going in, and they can measure the risk and reward. difference between a joint venture JV and a syndication. Okay, why syndication versus JV? So why we choose syndication versus joint venture is moving forward, because we've done both. Moving forward, syndication is of course pulling resources together, pulling people together. On a joint venture, we might have people that come in and they're great with investor relationships. They're great with placing capital on deals. They're great with relationships with family offices, but they might not necessarily be great at running the project, running the deal, raising the rents, renovating the units, doing the due diligence, the plumbing, the electrical. So there's certain team members that bring in certain qualities that others might not possess. Just like legal, you've got legal on your team, so your legal can draw up the sponsorship docs. They can make sure that your syndication is fully in compliance with the SEC. So you've got your legal on the general partnership, the GP team. You've got your project management, your property management, your asset management, your investor relationships management. So you've got a huge team that can come together on large deals. And then at the same time, we can bring in a group of investors, whether they're sophisticated, they're accredited or not accredited. We can bring in a group of investors, say $50,000 a piece or $100,000 a piece. And now we can purchase a large, say 100+ unit complex. So now we're able to do much larger deals because the deal can afford a much larger team, which makes us a bigger outfit. It makes us able to do better things. There's nothing wrong with joint ventures, but it just makes it tougher to be able to afford to do certain things on a project. What role does the SEC play with syndications? So the SEC is put into place again to make sure that sorry, let me get back here, to make sure that the deal is being done in the best interest of the investor, and that the general partners of the investment are staying in compliance with what the SEC says this is regulation. So essentially, the SEC tells us what we can and can't do, and that goes with capital raising, who we can and can't promote the deal to, and how we can promote the deal, all the way to how the deal is being reported, what our regulations are for reporting, what our notifications are. So everything is got to go within guidelines of what the SEC dictates to be what would be in the investor's best interest. So they're there to protect the investor, which that's how it should be. There are some bad actors out there that shouldn't be doing deals, and they do, and ultimately it catches up sooner or later. All right, what qualifications does a deal sponsor need to have? So if you're going to go out there and sponsor a deal, there's certain things that you need in order to even be a sponsor on a large deal, say 100-unit project. So the net worth of a balance of the loan. So if the loan is $10 million for a large project, the sponsor needs to have at least a $10 million balance sheet. So what does that mean? That means, or a net worth. That means that all of real estate, the asset value of the asset minus the debt would equal the equity of the deal. So that would be a positive on your net worth. Excuse me. You're going down your line of assets, and it needs to be equal to or greater than the loan of the asset, including all of liquid funds as well. Somebody on your team has to be on the loan as a loan guarantor. So if I want to be on the loan as the loan guarantor, I would need at least, let's just say $10 million loan for hypothetical. I would need a net worth of $10 million, plus I would need at least minimum liquidity of 10%. So I would need at least $1 million in the bank plus the net worth of $10 million to get a $10 million loan. Those are qualifications above and beyond of what your resume states to be on this specific deal. So the bank is going to underwrite that person as well. They're going to see what experience do they have. Say we're going to do 100 doors. Do they have the experience of managing 100 doors? If they don't, they can bring on, beautiful thing with syndication is that you can bring on team members that do have experience of 100 doors. So if it's between myself and let's just say Johnny's a property manager, he manages 500 units, but I've never managed it, but I can sign on the loan. So now I would be a signer on the loan and I'm partnering with Johnny in the general partnership. This is a beautiful thing with syndications. You bring on team members that make up the deficiencies of others. Let's see, liquidity and the 10% of the loan balance, went through that. You have the experience, somebody on your team that has managed these type of assets. So we went through the 3 points, and again, they're going to underwrite everyone on the general partnership and make sure that everyone's got the competence, the know-how to manage the deal and manage it in a way that's in the best interest of everyone involved. You can't just necessarily go out there and say you want to go and do something without having the experience. Yes, you could, but you probably wouldn't get too far with the bank or maybe with even investors. Okay, what about loan guarantors? So we touched on that a little bit, but loan guarantors are essentially the people that are coming in with the balance sheet. They're signing on the loan. They're saying they're giving their social, getting their credit pulled, giving bank statements. And essentially they can go recourse or non-recourse on a loan. So a recourse loan is that if the deal goes bad, now the bank can come after you. And since you've personally guaranteed it, they can come after all your personal assets. Hopefully you're sheltering your assets through another corporation, but if you're not, they can essentially seize those assets as well to make up the difference on the loan if the loan goes bad and it's a full recourse. If it's a non-recourse loan, which again, the great thing with syndication is there's a lot of loans that are non-recourse, and you can get these loans through agencies, Fannie Mae or Freddie Mac, and essentially, let's just call it $100 million loan. It could be non-recourse to where the bank, if the deal goes bad, the bank's going to take the property and then they're going to sell it, but they're not going to come after you personally. Now, there are going to be what we call bad boy carve-outs, meaning if you do something illegal, something that's completely negligent, let's just say you completely mismanage the property, you run it into the ground almost purposely, you're just totally negligent on it. There's going to be carve-outs within the framework of the loan docs that say, now we can come after you personally. So there's a recourse and there's non-recourse, but that's where the guarantors. It's like what place does a guarantor have on the general partnership? Well, they're taking risk with the general partnership operators of being a part of the deal. They need to be involved. They need to make sure that the right decisions are being made. They need to make sure that the property is being well managed. They need to make sure that the operators are executing on the business plan. But the loan guarantors are essentially the ones that glue the property together if no one else on the team qualifies or is able to. So they're extremely important. Special considerations about non-recourse loans. So non-recourse, of course, we've talked about it. It's not coming back to you on a personal level, but it does still hold you liable for things that could go wrong on negligence or fraud. If something happens to where they find that you've just lied about something and you've set things up to just be fraudulent on the deal, they can come after you. So just which there's a balance there. Non-recourse means that you've got to do things, got to act a certain way. All right, somebody who is a loan guarantor for these non-recourse loans and are things at stake, using their balance sheet, be able to get the loan. There are also a list that is another thing. You could be, if things go bad, you could be on a list, go on a list. Say the bad boy carve-outs deem that you're unfit, you're acting negligent on the deal, and the deal went sideways. You could go onto a list of not being able to get a loan again from the agencies or just non-recourse in general. So there's huge risks to being the guarantor. With risk comes reward. As long as you're managing the project alongside your other partners and things are going like they should, hopefully, then it should be a win. Okay, and now I've blocked out some time for some general questions here, and I'll bring in bear with me 1 second, bring in my screen, see if we've got questions. And see here. Get full screen. And get my chat box up. So if you've got any questions, just let me know here in chat. If not, we can certainly, I'll send out the recording and we will move on. All right, guys. So definitely appreciate everyone coming here. If you got any questions, just let me know and definitely appreciate it. Thank you.